Long-term liabilities. We're getting to the end of the balance sheet, which is always a good sign. On this one, I think the basic training videos are pretty good, and so I don't think I can really improve on those. Here, I'm just going to do the odds and ends, the little things that wasn't covered elsewhere. Long-term liabilities, that same probable future economic sacrifice, and like current liabilities, what makes them long-term is they're longer than a year. So they're even easier to kind of understand because they're things that are due in more than a year. The difference between like a note payable and accounts payable is there's normally interest involved in the long-term things, because FASB always assume nobody loans money for free. So even if it's on their marketing claim, there's no interest on your new sunroom or your new furniture for 2 years. For financial statements, you still have to book some interest, and you figure your regular revenue is a little bit less. Just a general FASB rule is no such thing as free money, because we have that time value of money. If it's not explicitly listed in a contract, then companies have to implicitly, they have to estimate what the interest is on that loan. I think this comes in handy. The name of the table is telling you what you're solving for. So a future value tells you that you're solving for the amount in the future. So what you know is you know how much you're going to put in the bank today. I'm going to put $10,000 in the bank today, and I'm going to buy myself a car when I graduate. And so I want to know how much I'll have in the future. If it's of $1, then it's one payment. The present value, you're solving for the present, so you must know the future. You know that car you want is $45,000. You want to know how much you're going to put in the bank today to get there. And again, if it's for $1, that's one payment. When I get to the annuities, then it's many payments. You're going to put in $1,000 every month or every year, and then you want to find out how much you got. Same thing though, the future, it's telling you you're trying to solve for the future. You know what the payment is. Because it's an annuity, we have a bunch of payments. Here it was a one-time deal. If it's a present value, solving for then is the present, you always have to know the payment. For accounting, we almost always are looking at present values, because I know something in the future, but I can't book future dollars. I can't make a journal entry that says this is for $300,000 in 10 years. My journal entry has to be the present amount. If you go into finance, then you're going to do a lot of future valuing, because then you care about, how much you're going to have in retirement and doing financial planning for people. But for accounting, we're usually solving for what's it worth today, so we can make that journal entry. Bonds are the things that make students crazy, because again, it's something that you don't know about. You've heard about stocks. You don't hear as much about bonds, but bonds you can go and buy just like you would buy a stock. And normally you buy a bond, it's a little bit more stable. You buy it for those cash flows. Bonds are almost always $1,000 face value, and that's called par. But when I just got this off of, I think it was Yahoo Finance. So this was just one for Lowe's. In this chapter, we're going to do that original issue from the company standpoint. But if I'm an investor, I don't have to buy it when it's originally issued. The whole point of bonds is you can trade them. And so this is a bond that was originally issued in 2008, and it's coming due in 2037. So I'm somewhere in between. So the price of the bond, while they will print it like 139, that's a percentage, and that's just the way they cite it. And you'll see that in your book. They'll say it's 97. It's really 97%. And it's a percent of the face value, which is always $1,000. So that means that for one bond, you'll pay $13.91. The coupon rate, sometimes called the stated rate, and this one is 6.65%, and it's always given. That again is the amount that they're going to pay you every period. What they're going to pay you is that, again, times the face value, $665. Put a 50 cents there. And they're going to pay it semi-annually, so actually you're going to get 33 and a quarter every 6 months. Our yield to maturity is the number that's important. Here you can tell you paid a premium. So this yield to maturity is what we call our market rate. That's telling you what everybody else is paying. And so for that 6.6, you're going to have to pay a premium. But the way the market works is it's efficient. So they're going to price the bond so that everybody gets this really 4% rate. It is also called the market rate. That's what they call it in your problems. Sometimes they call it the effective rate. That's what we really truly get, because we get 6.65 times 1,000, not 1,400. And we get $1,000 at the end, not 1,300. So if I would get out my present value tables and look up that series of cash flows at the 4%, that's where that 1,391 comes from. One thing that wasn't talked about in the videos is semi-annual interest rate, and almost all bonds pay semi-annual. They pay twice a year. But if you go back to our old formula, the rate, we'll say it's 6%. The principal, we'd say it's 1,000. And then the time, because it's always semi-annual, is always 6/12. So often we'll just take half of the interest rate. Take your interest rate, divide it by 2. But that also means that, thinking here, I get $66.50 a year, but I get $33.25 every 6 months. And the number of payments I get, I'll get twice as many payments. If I'm doing this on a present value table, the interest rate gets divided by 2, but the number of periods equals the number of years times 2. Because I'm going to get 3% twice a year. That's why on those charts it always says periods, not years. And that's what you'll look up on your tables. Use the same rate and periods for both the principal and interest calculations. The other thing that confuses students a lot, put out an extra little video in case that would help. This discount or premium thing, which one's which? Again, it all depends on the market rate versus the coupon rate. If the market rate is greater than the coupon rate, sometimes if you just put numbers there, it helps. But if the market rate is 10% and you're only paying 6%, nobody wants your bond. So that's a discount. If the market rate is less than the coupon rate, then that's the premium. And you only have to remember one, and the rest of it will all work itself out. So the way I look at it, my rate is 10% and everybody else's is 8%. My rate is kind of a premium. It's kind of an extra incentive to buy mine. And so that's going to have a premium. Some people look at it the other way. If the market rate is greater, then this one's kind of a discounted, trashy rate. And so that's a discount. Just to give you an example, so that Lowe's bond, the market's 4%, the coupon is 7%. So again, that coupon is kind of a premium bond. The market is 4%. Ours is this trashy little 2%. So they're going to discount that one. And I'm not going to get quite as much up front. If the market rate is 4% and the coupon is 4%, that's a trick question. Then it's sold at par, so at face value, or that $1,000 per bond, however you want to look at it. Last little thing I didn't do in the videos is talk about retiring bonds. If we have a discount or a premium over the period, when we make our journal entries, we keep writing up the bond carrying value or writing it down. So when we're done, the discount or premium account is zeroed out. And so when you retire your bond, let's say we have a $300,000 face value. When you retire it, your bonds payable has to go down, and we're going to pay cash. And when all's said and done, you probably have an interest payment right before you do that. But when you're finally ready to retire it, reduce the bonds payable, reduce the cash, you're done. Optional little features, callable. This says the company can retire the bond before the due date. So usually there's a date when this kicks in. Why might you do that? If interest rates change, it gives the company flexibility. And almost all bonds are callable at some point. SIU issued some bonds for the residence halls that when they issued them, they were paying like 6%. Well, now interest rates are like 1 or 2%. And so they've got that option to call those bonds and reissue them at the newer rates. Another one is convertible. And this is the bond is convertible to stock. There'll be some ratio based on the stock price. So it might be like you can get maybe 6 shares per bond. Well, let me make this a nicer number. 5 shares. So remember, the bonds are $1,000. If your stock price is ever around $200, people might convert those if it gets over that because they get a bargain. If your stock price is sitting at 10, nobody in the right mind would convert it because they can buy way more just at the current market price. Why might you do that? It's just an incentive to sell the bond. If you're having trouble selling bonds, sometimes you can put in a conversion feature, especially if you're a real new company. You might start with the bond and then you can convert it over. If you watch Shark Tank every now and then, they'll say, well, what if we start with debt and then we can convert it to stock if your company does well. Final little complications. Interest paid not at the fiscal year. You need to book interest expense as an adjusting journal entry, just like you do notes payable. It's nothing new. And then just a little aside, because if you're, and this isn't the company that's issuing the stock anymore, so this really goes more on the investment side, but if you decide you want to buy a bond, but you don't buy it on the interest date, interest is settled between the buyer and the seller. The ratio in this is the debt equity ratio, total liabilities divided by total stockholders' equity. Just wanted to contrast that. In a prior chapter, you did the debt ratio. The difference is the denominator. They're both telling you the same thing. They're both doing leverage. How much debt do you have? If you were doing the debt ratio, you'd have 100 over 300 would be my debt equity ratio. My debt ratio would be 100 over 100 plus 300 would be 25%. Both telling you exactly the same thing. Clearly a relationship between those. The most important thing, if you're just chit-chatting, people will use these terms interchangeably. So make sure you know which one they're using. I thought that would be real short, but of course it's not. But hopefully that helps.